Let's talk about a market update this week here on Phil's Tax Hacks and Other Retirement Facts. It's been a wild start to August, so we might as well get into it, break it down a little bit, and see what's going on out there in the markets. Let's go. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Phil and I are going to tackle a little bit of the scary, volatile, whatever's going on, Phil, with these markets. We're taping this on Tuesday, the 6th of August, and yesterday, Monday, was not a good day, and neither was Friday of last week, which I think that was, the 2nd, I think?
The 2nd, yep.
So anyway, let's get into a little bit. First of all, how you doing, my friend?
Doing good.
Yeah,
wrapping summer up.
Not too many panicked calls. Not too many people freaking out.
Didn't get any panicked calls. So I got
that's good.
A couple of emails earlier in the week as things were getting volatile, and but no.
Okay.
No, didn't get any panicked calls. So this will be a good just kind of update for clients and prospects of what's going on. And
yeah. Well, if you're looking at the news, right, obviously the Nasdaq took a hard hit. It's down 53. I think they're down as much as the lowest it's been in 53 years at one point, right?
At one point,
Monday.
yeah.
So pretty stark. Yeah. So that kind of stuff makes headlines and makes people nervous. So let's just kind of get into it a little bit. We got a couple of notes here, so we're going to reference some of this stuff so that we kind of get this right a little bit here, Phil. But let's kind of just do a little bit of background and some triggering effects on this, because I think people wonder. I think they wonder and they don't wonder what's causing this stuff with the market, right? Because look, all you got to do is look on just about any kind of wherever you want to get your news information from, whether you're on social media, whether you're on X, Twitter, whatever, whether you're on, looking at foreign news sources or current or, states news sources or whatever the case is. Markets and volatility is going, this is not just a U.S. thing. This is happening everywhere.
No.
And there's also problems everywhere, right? I mean, there's a lot of turmoil out there, so that's got a lot to do with it. But anyway, let's set this up a little bit.
Stark reminder of what a global economy we are in now, and market. So
yes, very true. And I guess it kind of started, Phil, if I'm right about this or if I'm not, let me know, with the Japanese market falling, the Nikkei. Is that how you say that?
Nikkei, yeah. Yeah, so I mean that's what triggered really Monday. The big sell-off on Monday was Bank of Japan, and this actually started on Friday. So on the 31st, Bank of Japan had their Fed meeting. From our view, the U.S., they're kind of their Fed meeting, and decided to end quantitative easing and start tightening, and had a surprise rate hike of a quarter basis point. Which, I mean, if you're thinking from our view in the U.S., I mean, you're thinking, what are you talking about? Rate hike? We've been doing rate hikes for, a year and a half, so what's going on? And they're just way late to the game in doing this. But I mean, over this time with quantitative easing, and put it in perspective, so their effectively Fed rate, the rate that they lend at was at 0. It was at negative 0.1 at one point. Wow. They raised it 25 basis points is all they've done. So, I mean, a small increase, but it caught the markets by surprise. And they're trying to prop up the yen, because as they had quantitative easing, I mean, that drops the value of the currency. And it's the yen has taken a beating over the last 2 years. So they're trying to prop the yen up. So with this, I mean, that just spiraled the market out of control. In Japan, lost over 12% on Monday. I think it lost 5 or 6% on Friday. So I mean, it was almost between the two about 20% over a couple of days. The reaction to that change, that pivot by the Bank of Japan.
And then our U.S. jobs market came out.
Yeah,
and the jobs data came out, right? So that piggybacked.
Yeah, and it wasn't. It wasn't terrible, but it wasn't good. As good as what
it was weaker. It was weaker,
right? And I mean, that's the crazy thing with markets is that it's all based on expectations, right? Markets price in what they think is going to happen way ahead of time. So because that jobs report didn't meet expectations, on top of then what's going on in Japan, the two of them came together and forced the market down.
So if that's the triggering effects, then we go to kind of the market reaction. So once it kind of starts happening, to your point a minute ago, it's a global economy. So things, then Europe didn't like that very much. So they kind of followed suit a little bit, right?
Yeah. So, it spreads across the globe. What happens in one economy, especially when there's that kind of a decrease in a market, at 12%, that is significant, in one day. So when you see that happen, it starts to spread across, even though it might not be reality. There might not be the real data behind it to justify that kind of a decrease. Panic sets in. And that's really, I think, what you saw on Monday was more that panic selling of, okay, what's going on in Japan? They're down 12%. How does that affect the U.S. economy, et cetera? On top of the fact that the tech market, this whole AI bubble that we've been in, has started to burst and people are starting to exit tech stocks. And that started earlier in the month. So mid-July, we started to see that shift happen where tech started to come out of favor, people exiting it. So, it's kind of a culmination of these different markets coming together at one point. But does that, necessarily mean this is the end of the bull run and we're now heading into a recession? And that's the big question at this point is now we're at a hard landing. Is that what's going to happen? Is this a recession? So, that's really, I think all those things coming together is what caused that volatility that you saw on Monday.
Okay. So, yeah. And to your point with that, Phil, thinking about August is historically a volatile month anyway. Right.
Yeah, it's a transition month. Yep.
It's a transition month, right? But I like what you were talking about there as well with watching some of the tech sell off. When Warren Buffett dumped a whole lot of stock last week, people should have had their eyeballs pop up a little bit. The guy tends to have some good feelers when it comes to things. So let's talk a little bit about the impact on the U.S. because to your point, we don't know where this is going to land. Some are saying that maybe the Fed has waited too long to cut rates. And they were talking about September, but does that change now? Who knows?
Who knows? There's talk now of an emergency rate cut, potentially. Who knows? That's all rumor. And that played into it as well. The Fed meeting last week of, kind of their hem-hawing and not committing to a rate cut in September because the data, right? They're going to follow the data. So all those things cumulatively are what played into it. So, there could be an emergency rate cut. Who knows? But generally, kind of bigger picture, that isn't necessarily good news because that triggers or means that the economy is slowing maybe quicker than we think, heading towards a recession. And now the Fed's trying to hedge that. So, it's a balancing act that they have to play. They're still combating inflation. Inflation started to peak back up again. That's why the Fed kind of stepped back from committing to that September rate cut.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
Yeah, so you're talking about they price things in, so some data out there looks like the markets are maybe pricing, there's a 78% chance that they're pricing a 0.5 percentage point rate cut in September, which again, they hem-hauled around about.
Right.
So they kind of feel like maybe it's still going to happen. So maybe that kind of softens this. Maybe, again, we're just into this Tuesday morning, so we really don't have any real data. It's just been the 2 days. So we don't know if this is going to be all week. It's going to be a problem or what. So this could age very well or very not so well, this particular podcast. But, I guess really what people worry about, Phil, is the long-term implications. And I think a lot of this is only going to get rockier because we are into August. We've got an election election now in 3.5 months or so. You've got all these other crazy factors that have happened. So, you and I tape these podcasts every so often, but we taped a couple at the end of July in advance for vacations, and a lot of stuff happened since we actually talked. Like, I don't know, an assassination attempt, and then a presidential candidate dropping out, and so this is like kind of historic. Yep. It's historic and not easily priced into anything because it's not really happened.
Right. Well, and markets in general don't like instability. They like stability. They like consistency. They like to know what's happening, the market as a whole. And when you get these unknown events like this, these unexpected events, like the yen and what's happened there, like what's happened politically. I mean, anytime there's things like that, it creates turmoil and unrest, in the market. But I mean, at the end of the day, it does come back to the reality of what's going on. It's always an overreaction. I would expect we're probably going to bounce back some. Who knows? I mean, it's been 2 days in a row. I think yesterday was driven just because of the yen. Friday, it started it. That wasn't too out of the ordinary. I think yesterday was way overpriced on the downside just because of what happened with the yen. It's an overreaction. And usually, I mean, if you look back, you'll see those overreactions one direction and then we start to regain it. Who knows, right? But at the end of the day, you've got to look at the real data when it comes to the economy. And granted, yes, the economy is slowing. But I mean, that's not necessarily a bad thing. We're reaching the end of this growth phase, but it's not collapsing. I mean, that's the important thing to remember. It's not like we hit a dead stop in the economy. Things didn't come out as good on the jobs number. The service sector, they came out and they're doing well, versus manufacturing. And actually service makes up 2/3 of our economy. So I mean, it's looking at the long-term data. I mean, we are still moving along pretty steady, slowing. It hasn't been the growth that we anticipated and have been used to, and we're in this transition period. So,
gotcha. Well, I mean, I think when we started this conversation, you mentioned that you hadn't had really any panic phone calls, which is great. That means people who have a plan are feeling a little bit, more stable than maybe folks who don't. There's still reason to be, I think, concerned. I think we're all going to get concerned when we see all this stuff happening. But overreaction is clearly, not the right step either. So that's why it's important to talk with your advisor if you do have concerns and just ask some questions. There's nothing wrong with, I mean, they're probably going to be expecting calls right about this time, if people get a little panicked. So if you feel, a little shaky, give them a call, have a conversation.
Absolutely. It's always better to reach out and have that discussion ahead of time. That's part of our job is helping clients walk through the emotional side of investing. The reality is, I mean, it's been a phenomenal year. Yeah, we've had some bumps along the way, but I mean, through mid-July, it's been just a phenomenal year. July itself, beginning part of July, was great. So having some of these drawbacks like this are expected. That's what markets do. They have this back and forth motion all the time. It's not just a steady up. So where we go from here, we're keeping an eye on it. Let's see what comes out with more economic data. The problem is now I follow a couple of different commentators, and we're kind of in this dead zone of economic data, for the next week or two before we start to get some more economic data out. So who knows, right? I mean,
that doesn't help. Yeah,
it doesn't help, right? Because we just had this downturn. So I mean, if we had some good economic data that would come in, that would help kind of stabilize things and maybe help us recover back from here. But
yeah, good point.
Just keep an eye on it, which is what we're doing. So.
Yeah, I mean, ultimately, if we're kind of sitting flat for a little bit, that's when people panic, right? And also the big headlines, obviously, the Nasdaq being at its lowest point in 53 years for a little while, that's very salacious, gets people panicked. You see things like $3 trillion lost in 2 days, and those things make people very nervous, right? And so that's when that's unfortunately when you make another decision and it starts this cascading effect where If everybody's panicking, then it will get worse, right? So you do have to kind of.
I mean, that's part of the Great Depression. I mean, when things like that happen, that panic selling, because it just spirals down. So, and I mean, there's certain triggers in the market now that stop that, causes pauses at point. Even circuit breaker where it shuts the market down for the day to prevent that kind of panic selling and running off on the market. But yeah, I mean, it's not comfortable. It's not easy. It's never, no one likes to see their accounts go down or hear those scary headlines. But just take a breath, pause, always take perspective, right? I mean, having a big drawdown like this is hard to look at, but step back and look at what's happened over the year. I mean, we've had a phenomenal year so far. So we're giving some of that gain back. Right? I mean, we were way ahead of what an average return would have been for the year anyways. And I always say, whenever you're above what an average return is, just understand you're borrowing that return, basically. At some point, you're going to give it back. Okay. We've given some of that back, so...
Yeah, that's a very healthy way of looking at it. Maybe it happened a little too fast for some people's comfort.
Well, and I think that's the biggest thing is the big drop that we saw so quickly, right? That it was, and that's always unnerving. Of okay, is this a the start of another 2008, or we're going to just spiral down from here? Usually, it doesn't happen that way. I mean, we have these back and forth motions and. Pay attention to the economic data and on top of it. And again, at the end of the day, if your plan is set up properly, where you have money positioned from a risk standpoint, we know this is going to happen. This is what markets do. They don't always just go in a straight line. So we have these ups and downs. The money that you have at risk, having some of this higher volatility, should be money you're not planning on using for 10 or more years anyways. So that's what's going to happen. You're going to have to get a little higher return, you're going to have that higher volatility. So, but again, doesn't make it any easier as you go through it.
Yeah, and that will help you not panic as much when you do realize that this is something that you're not having to grab a hold of, this week or whatever. But I like it. I want to end on that positive note of, it's been a really up year. So giving a little bit back is kind of norm for markets. So maybe if we kind of use that framing in our mindset, maybe that'll help us. So, but again, as we wrap up, if you got questions, as always, check with your advisor, reach out to them. If you're not working with an advisor or you need some help or you want a second opinion, reach out to Phil, have a conversation, get on his calendar, have a chat about some things. You can find him, online, obviously at philstaxhacks.com. That's our podcasting website. But of course, you could redirect back to his main website. You can follow him on Facebook, or you can check him out on YouTube as well. We've got our YouTube channel. You can listen to it on Apple or Spotify. So lots of ways you can get content from Phil. Just reach out to him again at philstaxhacks.com. That's philstaxhacks.com. And don't forget to hit the subscribe button here on YouTube and the little thumbs up so you catch new notifications as they come out. And we'll see you next time here on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.